Hello everyone, welcome to part 2 of lecture 1. So in part 1 we discussed banks, quick overview of the different things that they offered us, being deposits and loans, and then we moved into a bank's balance sheet looking at the different items for assets and liabilities and also stockholders' equity. So what we'll be doing today is doing a financial statement analysis. So in this particular section, we are going to be focusing on different ratios that we can use to assess the financial health of these banks. So a couple of the ratios that we'll be looking at is, first of all, return on equity. So return on equity measures overall profitability relative to the firm's equity. We also have ROA, your return on assets, measures your overall profitability relative to a firm's assets. We'll also look at the equity multiplier, which measures how much of the firm's assets are funded with equity relative to debt. This is a leverage ratio. Leverage being the amount of debt in the company's capital structure, in the bank's capital structure. Profit margin measures the ability of the firm to pay expenses and generate income. Asset utilization measures the amount of operating income generated relative to total assets. Operating income is broken down into two components. You have interest income and non-interest income. So in another ratio that's very similar to this is total asset turnover, which is an asset utilization ratio that uses sales, but with banks they don't have sales, so we use operating income instead. And then you also have spread. Spread measures the difference between the average yield on their earning assets and the average cost of their interest-bearing liabilities. So the textbook really emphasizes spread, but another important measure that you may see, just to give you a heads up, is net interest income, but we'll be utilizing spread in our analysis. So we'll be focusing on these different ratios, but another thing that you should always keep in mind is how much is the bank generating in interest income and how much is the bank paying in interest. That's something else that should always be considered when you're looking at bank's financial statements, but we'll be focusing on these different ratios. So first of all, let's look at return on equity. So return on equity, up at the top there in the blue box, you have your balance sheet identity, which is simply assets equals liabilities plus equity. Return on equity is simply how much profit or how much net income are they generating on their equity base. So what we can do is we can multiply both the top and bottom of this ratio by assets, and that will not change the value of that particular ratio. And then we can rearrange it, move assets over here, move net income over here, and we can now have return on equity broken down into net income over assets times assets over total equity. And what is nice about this is net income over assets is simply ROA, your return on asset equation or ratio, and then assets over total equity is your equity multiplier, that leverage ratio. So what we've done is we've taken ROE, and instead of just having it at net income over total equity, we've now broken it down into return on assets times the equity multiplier. So how profitable is the bank at utilizing their assets to generate income, net income, and then how much leverage are they using? So what you can see is that a bank can actually magnify their ROE by either increasing their ROA or increasing the amount of leverage that they have in their capital structure. Next step is to focus on ROA. ROA is net income over total assets, and what you can do with this ROA equation is very similar to the last one. We can multiply both top and bottom by the same value. In this case, we're going to multiply both top and bottom by operating income. Operating income being interest income and non-interest income. Multiply both top and bottom. Once again, rearrange the top. And net income over total assets is simply your profit margin, and operating income over total assets is simply your asset utilization ratio. So basically what we've done is we've taken ROE and first broken it down into a component of ROA times your equity multiplier, and then took it one step further and broke down ROA to see that ROE is a component of the company's profit margin, their asset utilization, and their equity multiplier. So we've been able to take our ROE and break it down into different ratios to see what the main drivers are of a bank's ROE. And then last up, focusing on spread. Remember that spread is the difference between lending and borrowing rates. So typically the higher the spread, the more profitable the bank. But it is something to consider that with the higher spread, you do have to consider the potential risk implications of obtaining that higher spread. So that is something that needs to be considered when you're looking at companies or looking at banks and their spread. So your spread equation is interest income divided by earning assets. So this is simply your average yield on earning assets minus your interest expense divided by your interest-bearing liabilities. This is your average cost of your interest-bearing liabilities. Well, this will be a little bit more clear when we do our example, but what are earning assets? Earning assets are any asset that earns interest for the bank. So what are the assets that earn interest? You have your investment securities, and you also have your net loans. What are your interest-bearing liabilities? These are any liability that that the bank has to pay interest on. So they do not pay interest on their demand deposits. That's just your checking account, and then they don't pay interest on their equity balances. So those are not interest-bearing liabilities. So what we're going to do now is we're going to do an analysis and apply these ratios and our understanding of the balance sheet to Bank of America's balance sheet, and then assess the financial strength or the financial do a financial statement analysis on. Okay, so let's apply what we've covered so far and do a financial statement analysis for Bank of America. Here what we have is Bank of America's 2016 financial statements, and what we're first going to do is apply the different items and kind of match up what we discussed in part 1 of this lecture, the different types of assets and liabilities that banks can have. So the first type of asset that we discussed was cash and cash equivalents. Here you can see on the balance sheet for Bank of America, line items 1 through 4 represent those different cash accounts. So you have vault cash, your deposits at the Federal Reserve, your deposits at other financial institutions, and your cash items in process of collection. But these are all your cash items, and that was the first type of asset that we discussed in lecture 1, or in part 1 of lecture 1. Second type of asset were our investment securities. We talked about federal funds sold, and we also talked about repos. You can see that here it's an asset, so they must have been the lender in this repo. But that was our second type of asset that we discussed, were investment securities. Our third type of securities were net loans and leases. What's important to focus on here, what I want to showcase here, is that they do have this reserve for loan and lease losses. As mentioned previously, they know that some loans are going to default, and so they deduct that or they have that reserve on their assets here on the balance sheet. And then we have our other assets. So some other assets being your trading account assets. You also have your premises and fixed assets. You do see the word premises on your quiz. Premises just represent like buildings. So your other real estate owned and so forth. But those are the assets for Bank of America. Then in part 1 of this unit, we also discussed liabilities. So liabilities are what they have to pay interest on. The first type of liabilities were their deposits. You can see they have demand deposits, so your checking accounts, your NOW accounts, your MMDAs, your other savings deposits, so all those different deposits. Then you also have borrowed funds, so you have your federal funds purchased and your repurchase agreements. So these are the ones where they are the borrower on the repo agreement. And that comes up with our total equity or our total liabilities, and then what remains is our total stockholders' equity. Then over on the right-hand side, you can see we have our income statement with a lot of different line items. To simplify things, what I've done is kind of give you a summarized income statement. So we have our total interest income, we deduct our total interest expense, and we also deduct our provision for loan losses. We also have non-interest income, and we deduct our total non-interest expense and our taxes, and we come up with a net income. What's important to understand is that total interest income and non-interest income, that is your operating income for a bank. So as we go through our ratio analysis here for Bank of America, keep in mind that those two together, interest income and non-interest income, represents your operating income. So we have our balance sheet, we have our income statement. Let's do a return on equity analysis here down at the bottom. So the first thing that we'll do is calculate return on equity, which once again measures the profitability of the company on their equity base. Return on equity is equal to net income divided by total equity. So what I'm going to do here is take net income and divide it by their total equity, and I get a return on equity of 7.20%. Next ratio that I want to look at is ROA. So ROA is equal to net income divided by your total assets. And I get a return on assets of 0.91%. The next thing I want to do is look at their leverage. So I look at the equity multipliers. So the higher the equity multiplier, the more leveraged they are. So leverage both magnifies gains and also magnifies losses. So to get the equity multiplier, I take total assets divided by total equity. And again, equity multiplier 7.94. And what I want to do now is I want to reinforce that first step of the DuPont that we did in part or earlier in this lecture, where I broke down ROE into ROA times the equity multiplier. Let's just showcase that that is indeed true. So if I take ROA and I multiply it by the equity multiplier, I should get the ROE equation or the ROE value, and you can see that I get the same thing. So that just reinforces that the return on equity value is a component of both the return on assets and equity multiplier. And what you can do is you can compare two banks' ROE and see if one bank has a higher or a comparable ROE based on their profitability with their asset base, or are they competing, or do they have is their ROE misrepresentation because they're using more debt, a higher equity multiplier. Next up, let's look at profit margin. So profit margin is net income divided by operating income. So once again, net income divided by, and this is where you need to remember what the equation is for operating income. Operating income is the sum of total interest expense or total interest income and non-interest income. So I add those two together for my operating income, and I get a profit margin of 22.83%. And then asset utilization is your operating income divided by total assets. So once again, operating income being the sum of interest income and non-interest income. Now we are dividing it by your total assets, and I get a asset utilization ratio of 3.97%. Let's reinforce once again that ROE is actually a component of profit margin, asset utilization, and equity multiplier. So this is our full DuPont. I can go ahead and multiply the profit margin times the asset utilization ratio times the equity multiplier and see that I get that same 7.20%. So if I wanted to, I could go ahead and convert this to percentage and indeed keep this or showcase that it is the same. I'm having trouble finding that right now on the iPad. And then last up is your spread. Your spread is your interest income divided by your earning assets minus your interest expense divided by your interest-bearing liabilities. Pretty easy to see the interest income and then the interest expense on your income statement. Earning assets and interest-bearing liabilities are a little bit more complex with the way that this balance sheet is set up for such a large bank. So to simplify things here, I'm just going to give you this value. It's 3.03%. But what we'll do here on the next problem is actually calculate the spread looking at the balance sheet and income statement for a smaller bank. So let's go ahead and turn our attention to a problem that is a little bit more similar to what you might see to what you'll see in your quiz. Okay, so let's take a look at a problem with financial statement analysis that's very similar to one that you'll have to complete in your quiz and upcoming exam. So here we have a simplified balance sheet and income statement, and once again we're doing a financial statement analysis, and the questions that we need to answer are located in the bottom right corner. So first of all, the question asks, how much earning assets does this bank have? So with earning assets, we're thinking about any assets that are earning interest. So we go over to our balance sheet and look at the asset column, and we look at which assets here would actually earn interest for the bank. So does cash earn interest for the bank? No, cash does not earn interest for the bank. Secondly, demand deposits from other financial institutions. Well, demand deposits are just checking accounts. Once again, do not earn interest for the bank. T-bills, yes, they do earn interest, so that is an asset earning or an interest earning asset. Federal funds sold, so they've loaned funds to other banks using the federal funds rate, so that does earn interest, that federal funds rate. Do loans earn interest? Yes, they do. And then we need to keep in mind that we do have a reserve for loan losses, which we'll need to deduct from this earning assets value in our final calculations. Premises are simply buildings. Do they earn interest? No, they do not. So we have our 4 items there. So the first thing is to calculate what is the total of earning assets, which is simply equal to the sum of the 4 items previously mentioned. So I add these up, and you can see that I made a mistake by accidentally clicking on the demand deposit. So it's actually T-bills plus federal funds sold plus loans, and then I need to deduct the reserve for loan losses, but since I have it already listed as a negative, I can just add that in, and my total earning assets is $20,875. Now the quiz also has investments as one of the assets. So do banks earn interest on their investments? Yes, they do. So you would also include that value in your earning assets calculation. Next up is to calculate ROA. ROA is net income divided by total assets. If I look over here with my simplified income statement, I do not have a net income yet calculated. So what I need to do is look at these different income statement items and identify whether or not they would be income or actually expenses that need to be deducted. So what we have here is interest income is where we start, but then we have an interest expense, so I need to deduct that from my interest income, and then my provision for loan losses also needs to be deducted. So what I need to do is subtract that value as well. So let me just type back in that cell for interest expense, minus my provision for loan losses. I have non-interest income, which would be an addition. So I add in the 190. I have a non-interest expense that I need to deduct, so B16 needs to be deducted, and then I also need to deduct taxes, and I end up getting a value of net income of $390. Now I can calculate ROA. So once again, ROA is net income divided by total assets. I get an ROA of 1.57%. The next value, or the next question, asks what is the asset utilization ratio. So once again, your asset utilization ratio is operating income divided by total assets. We need to first calculate operating income. As I mentioned previously, operating income is simply interest expense plus non-interest expense. So both of these values come, or interest income plus non-interest income. So I need to sum those together for operating income and then divide by my total assets, and I get an asset utilization of 12.2%. And then the last one is the most difficult, and it is what is the spread? Well, your equation for spread, as mentioned previously, is interest income located there on the balance or on the income statement divided by earning assets, which we calculated in our first step here of $20,875, minus interest expense, again on the income statement, divided by interest bearing liabilities. So the first thing that we need to do is we need to calculate our interest bearing liabilities. So what liabilities does this bank have that they have to pay interest on? So we go up to their balance sheet and we look at their liabilities portion and ask ourselves, do they have to pay interest on any of these liabilities? Do you pay interest on a demand deposit? Think of what a demand deposit is. It's simply a checking account. So no, they do not pay interest on these demand deposits. Do they pay interest on small time deposits? So these would be like your small CDs. Yes, they do pay interest on these, so we would include that as an interest-bearing liability. Jumbo CDs, do they pay interest on those? Yes, they do. And then you can also see that they actually have federal funds that they have purchased. So they have borrowed where they would pay the federal funds rate, so they would pay interest on that amount. Equity obviously is not a liability, an interest-bearing liability, so we do not include that equity value. So we have three items that are interest-bearing liabilities. So once again, I'm just going to sum these up, and I get a total amount for interest-bearing liabilities that is equal to $17,250. So the spread here is that equation that we have down below. So we have interest income, which is $2,850 from the income statement, divided by our earning assets that we calculated in part 1, minus interest expense from the income statement divided by interest-bearing liabilities, what we just calculated, G16 here. And so I get a spread of 2.87%. So basically, all we're saying there is that their earning assets have an average yield of that exceeds their average expense on their interest-bearing liabilities of 2.87%. So once again, the more profitable the company, the higher the spread. But you'll have a very similar question there on your quiz, where you are given a simplified balance sheet and a simplified income statement, and you are asked to answer the following questions. So now let's just conclude this second part of lecture 1, going back to. Okay, so to wrap up this first lecture, let's take a look at the top U.S. banks by market capitalization. The top bank in the United States is J.P. Morgan. They have a market capitalization here in 2020 of $423 billion. And then number 2, you can see we work our way down to Bank of America, Wells Fargo, Citigroup, all the way down to Charles Schwab. Charles Schwab has a $60.8 billion market cap, but these are the top U.S. banks, and what's interesting is that 3 banks that are headquartered in Ohio are among the 25 largest banks nationwide, and those banks include Fifth Third, Key Bank, and Huntington. So we've discussed what banks can offer and what their balance sheets look like, and this is just giving you an idea of some of the largest banks here in the U.S. and then also in Ohio. So to wrap things up, reviewing the concepts, what deposit options does a bank offer? Well, we know that the banks offer demand accounts, NOW accounts, MMDAs, and also savings, and then they also offer CDs. And then what loan options does a bank offer? They have real estate, consumer loans. They also have C&I loans. And then what does a bank's asset liability mismatch mean? That just simply means you have long-term assets being funded by short-term liabilities. What are a bank's main assets? Cash, investments, net loans and losses. Those are the bank's main assets that we discussed. What are the bank's main liabilities? So we have your deposits and borrowed funds. Why does a bank need equity? So the equity actually acts as a shield against losses on their assets. And then how do you calculate ROE, net income divided by total equity? We also broke it down into ROA times the equity multiplier, and then one step further and said that ROE can be broken down into profit margin, asset utilization times, or profit margin times asset utilization times the equity multiplier. And why is it important? Well, it's important because it is a key measure of a bank's profitability. So that wraps up Lecture 1. So we had 2 parts here with Lecture 1. Don't forget to answer your lecture question online, and I will talk to you all soon. Good luck.